A ceasefire between the United States and Iran pushed the TSX over 200 points Friday, its 5-week high, while the same conflict sent U.S. consumer prices to their sharpest annual rise in 2 years. Both things happened on the same day. That is not a contradiction. It is the structure of how energy shocks travel. The Iran war that began in late February did not just disrupt oil flows. It closed the Strait of Hormuz to normal commercial traffic. The strait carries roughly 20% of the world's traded oil. When it narrows, energy costs surge globally within weeks, not months. By March, U.S. CPI rose 0.9% in a single month, pushing the annual rate to 3.3%. The Bureau of Labor Statistics confirmed that almost the entire March jump came from energy. Food inflation barely moved. The University of Michigan's Consumer Sentiment Index hit a record low of 47.6 in April, down more than 10% from March. One-year inflation expectations jumped a full percentage point to 4.8%. Survey respondents explicitly blamed the Iran conflict. That matters because inflation expectations are self-fulfilling at the margin. When consumers expect prices to rise, they accelerate purchasing, which pushes prices higher. Iran then complicated the reopening. Iranian officials announced plans to charge oil tankers passing through the strait a per-barrel toll, payable in cryptocurrency. The crypto analytics firm TRM Labs estimated Iran's military collected up to $2 million in toll payments since mid-March, accepting Bitcoin, Chinese yuan, and stablecoins. The formal scale of that system remains unclear, but the signal is not. Iran is treating the strait as revenue infrastructure, not just a military lever. Oil settled near $98.75 a barrel Friday, still elevated, but fell sharply week over week as ceasefire hopes mounted. For Canadian oil sands producers, analysts flagged potential 20% upside if Hormuz constraints persist. That trade reverses fast if the ceasefire holds and tanker traffic normalizes. The same ceasefire that lifted oil-linked TSX names added a layer of complexity to the Bank of Canada's calculus, and not in the direction most investors expected. Canada added 14,100 jobs in March, matching expectations after shedding 83,900 in February. The unemployment rate held at 6.7%. On its face, that is stabilization. But TD Securities and BMO both read the same number and arrived at the same conclusion. The Bank of Canada will leave rates unchanged for the rest of 2026. The mechanism is not obvious. Canada's labor market has been described by economists as frozen, a market with low hiring and low firing, where companies are neither expanding nor contracting. That structural stasis does not respond well to rate cuts. Cutting into a frozen labor market risks stoking inflation without producing real job growth. Hiking into it risks tipping a fragile economy into contraction. Markets were pricing in 33 basis points of tightening this year from the Bank of Canada as of Friday afternoon. That residual expectation reflects the view that sticky, energy-driven inflation eventually forces the BOC's hand. The same energy shock driving U.S. CPI is passing through Canadian fuel prices, with diesel costs forecast to remain elevated for months. Diesel matters disproportionately because it feeds into transportation and food distribution costs that hit consumers with a lag. The Canadian dollar gained 0.8% for the week, its best weekly performance since January, as the ceasefire reduced safe haven demand for the U.S. dollar. But the loonie gave back ground Friday after the tepid jobs data. USD CAD settled near 1.3834. The USMCA trade agreement, which shields much of Canada's exports from U.S. tariffs, faces review by a July 1 deadline, a political variable that no rate model prices cleanly. If the ceasefire holds and energy prices fall, Canadian inflation may moderate enough to keep the BOC genuinely on hold. If the strait remains partially constrained and diesel stays elevated, the frozen labor market and rising price pressures coexist, which is the worst scenario for rate policy, because neither cut nor hike resolves both at once. The week's third structural move came from a single AI model release, and it hit the financial sector before it hit technology stocks. Anthropic released a new AI model called Claude Mythos. Within days, U.S. Treasury Secretary Scott Bessent summoned the CEOs of the largest American banks to discuss potential financial sector risks.
Canada's Financial Sector Resiliency Group, chaired by the Bank of Canada's Chief Operating Officer, including representatives from OSFI and the country's 6 largest banks, convened an emergency meeting the same week specifically to address cybersecurity risks posed by Mythos. The risk being discussed was not theoretical. Mythos was flagged as capable of identifying software vulnerabilities at a level Anthropic itself deemed too powerful for unrestricted release. That capability, combined with Iran-linked TACOs already targeting U.S. critical infrastructure, water systems, power plants, medtech companies, created a convergence regulators treated as urgent. Stryker, the medtech company, was offline for 3 weeks after a March cyber attack by an Iran-linked group. The FBI and NSA issued a joint advisory warning that critical infrastructure was being actively targeted. For markets, Mythos had a separate effect. Anthropic's annual recurring revenue hit $30 billion, up from $9 billion at year-end 2025. That growth rate prompted investor Michael Burry to publicly argue that Anthropic is displacing Palantir as the enterprise AI platform of choice. Palantir fell 13% over 2 days. Software stocks broadly sold off as investors repriced the assumption that traditional enterprise platforms retain pricing power when a more capable underlying model exists. CoreWeave, by contrast, jumped 11% after announcing a multi-year infrastructure deal with Anthropic. 9 of the top 10 AI model providers now run on CoreWeave's platform. The weight of evidence points toward continued disruption in enterprise software evaluations, but only if Anthropic sustains its growth trajectory and Mythos proves durable in enterprise deployment, not just benchmark performance. If Palantir's revenue growth, which accelerated to 70% in Q4, continues into 2026, the market's narrative about displacement reverses. Strong results would suggest AI model providers power enterprise platforms rather than replace them. The verification benchmark is Palantir's next earnings report. Revenue growth decelerating below 50% gives structural support to Burry's thesis. Revenue holding above 60% suggests the sell-off was premature. What the week leaves unresolved is whether a ceasefire changes anything durable. The Strait of Hormuz toll system already exists. The Anthropic disruption cycle has already started. The Canadian labor market was frozen before Iran, and it will be frozen after. The variables that moved markets this week are not going away in April.